Bismillahirrahmanirrahim. This is the first video on proof property cost disposition under successful efforts method. In this video, we are going to talk about cost disposition through amortization. We will explain how to calculate DD&A, that is depreciation, depletion and amortization. We will explain how to calculate DD&A when oil and gas reserves are produced jointly and on a field-wide basis. And finally, we will explain how to calculate estimated future dismantlement, site restoration, abandonment costs, and salvage value. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on proof property cost disposition under successful efforts method and want to refresh how to calculate DD&A when oil and gas reserves are produced jointly and on a field-wide basis, and how to calculate estimated future dismantlement, site restoration, abandonment costs, and salvage values. So, let us start with discussing cost disposition through amortization. Assets disposal is the removal of a long-term asset from the company's accounting records. It is an important concept because capital assets are essential to successful business operations. In financial accounting, tangible property and equipment is depreciated, intangible property is amortized, and natural resources are depleted. For oil and gas financial accounting, depreciation, depletion, and amortization of proved property and wells and related equipment and facilities is referred as DD&A, that is depreciation, depletion, and amortization. Proved reserves are the properties that are reasonably certain of producing oil. Such reserves are of two types: proved developed reserves and proved undeveloped reserves. Proved developed reserves are the completed reserves that are ready to produce from existing wells and equipment, and no additional cost needs to be incurred. Proved undeveloped reserves are the reserves that will produce only after incurring additional future cost. In successful effort companies, acquisition costs are of two types: cost of proved properties and the cost of wells and related equipment and facilities. Both the costs are amortized to become part of the cost of oil and gas produced. Only proved reserves are used to amortize the acquisition cost. While wells and related equipment and facilities are amortized over proved developed reserves, the remaining proved reserves, that is proved undeveloped reserves, are excluded in amortizing wells and related equipment and facilities because those reserves will be produced only as a result of incurring additional future cost. Once a property is fully developed, proved reserves and proved developed reserves are the same. You should also keep in mind that the acquisition cost represent expenditures made on behalf of the entire cost center and thus apply to all reserves that will be produced from that cost center. Both acquisition cost and the cost of wells and related equipment and facilities are amortized using the unit of production method, and the formula is book value at year end divided by estimated reserves at the beginning of the year times production for the year. Look at the denominator that calls for estimated reserves at the beginning of the year, and this will be calculated by adding the production during the year to the estimated reserves at the end of the year, as it includes the current year discoveries too. In our discussion of amortization, proved reserves, proved developed reserves, and the current year's production refer to the working interest owner's proportionate share of reserves and production. Next, let us see how we measure oil and gas. Oil reserves and oil production is measured in terms of barrels. A barrel is 42 gallons of oil measured as a standard temperature of 60 degree Fahrenheit. Gas reserves and gas production is measured in terms of MCF, that is metric cubic feet. A metric cubic feet is 1000 cubic feet of gas measured at a temperature of 60 degree Fahrenheit under pressure of 14.73 psia, pounds per square inch absolute. Next, let us solve an exercise on cost disposition through amortization. Lucky Oil Company drilled the first successful well on lease A. The company plans to develop these leases over the next several years. Data for the lease as of 31st December are as follows, and we have to calculate the DD&A, that is depreciation, depletion, and amortization. So first, the reserves of as of the beginning of the year are going to be determined, and this will be done by calculating the estimated proved reserves at the beginning of the year. Now here we are given the proved reserves, estimated proved reserves. Estimated proved reserves at the end of the year, and that is 895,000. To this we add the current year's production, that is 5,000. So the total is 900,000. Then we determine the estimated proved developed reserves, and estimated proved developed reserves at the end of the year is is 95,000, and the current year's production is 5,000. So the total estimated proved developed reserves is 100,000. Next, we are going to calculate the DD&A for leasehold properties, and this is calculated by the unit of production formula, and that is book value at the year end, and the book value at year end is 50,000 for leasehold cost times production during the year, that is 5,000 barrels, divided by the estimated proved reserves, that is 900,000. So this is equal to 278. Then we calculate DD&A for intangible drilling cost and lease and well equipment, and this is equal to 120,000. So 90 plus 30 is 120,000 divided by the estimated proved developed reserves, that is 100,000 at the beginning of the year, times the production, that is 5,000 barrels. So this is equal to 6,000. Let us solve one more exercise, or let us solve one more rather similar exercise. And Ajax Oil Corporation drilled its first successful well on lease A in 2018. Data for lease A as of 31st December are as follows, and we have to compute amortization, and don't forget it will be for both leasehold cost as well as wells intangible drilling cost and lease and well equipment. So first of all, let us calculate the DD&A for the leasehold. Now the production during the year is 8,000 divided by the total estimated proved reserves at the, because this is at the end of the year, 792,000. We are going to add the production during the year, and we are going to multiply by the leasehold cost of 50,000. So this is equal to 500. Next, we are going to calculate the DD&A for intangible drilling cost and equipment. So the production during the year is 8,000 divided by total estimated reserves recoverable, that is 102,000, and because this is at the end of the year, we are going to add the production, that is 8,000 times the wells and intangible drilling cost and lease and well equipment, that is 275,000. So this is equal to 20,000. Next, let us talk about DD&A when oil and gas reserves are produced jointly. And just keep one thing in mind, that a barrel of oil is equal to 6 times of metric cubic feet of gas. So most reservoirs contain both oil and gas, and it is therefore necessary to convert oil and gas reserves and oil and gas produced to a common unit of measure based on relative energy content. However, if the relative proportion of oil and gas extracted in the current period from the reservoir is expected to remain the same, then amortization may be computed based on only one of the two minerals, either oil or gas. Or if either oil or gas clearly dominates both the reserves and the current production based on relative energy content, then amortization may be computed based on the dominant mineral only. If these conditions are satisfied, then amortization can be done by three different methods of if oil and gas reserves are produced jointly. First, it can be a common unit of measure, that is converting to a common energy unit. It may be same relative proportion using either oil or gas, or it may be dominant mineral using the dominant mineral. Let us solve an illustration in this regard. Ajax Oil Corporation drilled its first successful well on lease A in 2018. Data for lease A as given to us, and we have to calculate the D-joint production DD&A by all the three methods that we have just now referred to. And let us look at the first one, that is calculate DD&A assuming it is determined on a common unit of measure, either equivalent barrels or metric cubic feet. So first of all, we are going to go for this calculation. It can be either equivalent barrels. So first we are going to convert the barrels of into convert the production and the estimated proved developed reserves in barrels of oil equivalent. Now the production is 50,000 barrels, so it remains the same 50,000 barrels, while gas will be converted into barrels of oil equivalent by dividing 240,000 by 6. Just keep this thing in mind. A barrel of oil is equal to 6 times of metric cubic feet of gas. So this is going to be 240 divided by 6. 6, that makes 40,000 barrels of oil equivalent, and this is equal to 90,000. Then we will convert the total proved developed reserves into barrels of oil equivalent. Oil will remain the same, 400,000 barrels, while gas will be converted by dividing this by 6. So this is going to be 6 threes, that makes 300,000 barrels of oil equivalent, that is equal to 700,000. Next we are going to equate it to metric cubic feet. Once again we have the oil production, and now rather dividing we are going to multiply this by 6. So 550,000 times 6, that makes 300,000 equivalent of metric cubic feet. Gas will remain the same, it is given in 240,000 metric cubic feet, and the total will be 540,000. Next we are going to calculate the total proved developed reserves. And for the proved developed reserves, the oil is 400,000. We will multiply by 6. This will become 2,400,000. Gas will remain the same, 1,800,000 equivalent of metric cubic feet, and this is metric cubic feet, and then this is divided by 4,200,000. Next we are going to determine the proved developed reserves at the beginning of the year. Now we have the proved developed reserves at the end of the year, that is on December 31, 700,000. Barrels of oil equivalent. The production was 90,000 barrels of oil equivalent, that makes 790,000. And we can calculate the DD&A now. Now for the DD&A, we have the net capitalized cost, and the net capitalized cost is 2,200,000 divided by proved developed reserves at the beginning of the year, and this will be in barrels of oil equivalent, and that is 790,000. And because this is at the beginning of the year, that's good, and we are going to multiply by the production and during the year, that is 90,000. This is equal to 250,633. Okay, next we can we can solve it the same problem with the equivalent of metric cubic feet. So proved developed reserves in metric cubic feet was 4,200,000, equivalent of metric cubic feet. To this we are going to add the production, and the production in metric cubic feet is 540,000, equivalent of metric cubic feet, and this is equal to 4,740,000 equivalent of metric cubic feet. So the DDA in this regard will be, we have once again the net capitalized cost, and the net capitalized cost is 2,200,000 divided by proved developed reserves at the beginning of the year, but this time this will be in metric cubic feet, and that is 4,740,000 times the production in now in metric cubic feet, that is 540,000. So once again, if you calculate, this will be 250,633. So we have the same result whether you do it by metric cubic feet or barrels of oil equivalent, and the journal entry will be DD&A expense debit by 250,633, and accumulated depreciation and DD&A is 250,633. Okay. Next, let us solve one more exercise on oil and gas reserves being produced. Okay, we will continue, sorry. We have done the first one, and we now move on to the second requirement. And here they say assume the relative proportion of oil and gas extracted in the current period is expected to remain the same, and that lucky company decide to calculate DD&A using only gas. So we are going to calculate by using only gas, and we are going to take the information for gas only. So we have proved developed reserves on 31st December, it is 1,800,000. Current year's production is 240,000. So the total is 2,040,000. Now we are going to calculate the DD&A. So the net capitalized cost is the same, 2,200,000 divided by proved developed reserves at the beginning of the year, that is 2,040,000 times the production, and the production was 240,000. So this is equal to 258,824. Okay. Next, let us look into the third requirement, that is assume that oil. Okay, before in this example we have looked into that gas. We have calculated DD&A using gas, and now we are going to do it with oil as being dominant. So let us calculate this one, and this time we are going to take the oil in our calculations only. So the oil is 400,000. Proved developed reserves, current year production is 50,000. So the total at the beginning of the year is 450,000, and because all this information is in barrels, not in metric cubic feet but in barrels. Using only BOE, sorry, no, barrels only. So net capitalization cost is 2,200,000 divided by the proved developed reserve at the beginning of the year, that is 450,000, times the production, and the production was 50,000 for oil, and this is equal to 244,444, and the journal entry to record depreciation will be DD&A expense debit 244,444, and accumulated depreciation is credit by 244,444. Okay. Let us solve one more exercise on oil and gas reserves when they are produced jointly. And here Chavez Petroleum's lease in Wyoming produces both oil and gas, and we have the information over here. We have to compute amortization assuming the lease is fully developed. Assuming, so first of all, we are, when it is fully developed, we are going to take into account all the costs. So we have the intangible drilling cost of 900,000. We have the proved property of 100,000, and we have the lease and well equipment of 300,000, and the beginning will be subtracted, that is 50,000. So that is equal to 1,250,000. Now we can calculate the DD&A. So the total cost to be amortized is 1,250,000, and this is going to be divided by the proved developed reserves at the beginning of the year, and that is going to be how much? It is going to be 200,000. Estimated proved reserves is 200,000 plus the oil production, because this is at the end of the year, plus 10,000 multiplied by 10,000, and this will give us 59,524. Then so oil, we have used oil in part A, and we have used all the information for oil in this regard. And next we go for part B, and in part B they say using a common unit of measure based on barrels of oil equivalent. So we are going to use barrels of oil equivalent. So oil, proved reserves for oil is 200,000 barrels, and gas will be converted into barrel by dividing by 6, that will be 166,667 divided by and the total will be 366,667 barrels of oil equivalent. For production, once again, oil is 10,000 barrels. For gas, again we will divide this by 6. So 300,000 divided by 6 will give us 50,000. That makes 60,000 barrels of oil equivalent. And now we can calculate. We have the cost to be amortized, that is 1,250,000. 1,250,000 divided by the proved reserves, that is 366,667 plus the production in barrels of oil equivalent times the production, that is 60,000. So that gives us 175,781. Okay, so we have done both of them in this case. And next, let us talk about DD&A on a field-wide basis. Now, acquisition cost represent expenditures made for the entire cost center, and it applies to all reserves that will be produced from that cost center. So such properties have a common geological feature such as a field or a reservoir. It is important that all the properties that are geologically related will be combined for amortization purposes in cases where properties cover a single reservoir or a single field. So if a field or reservoir is used as a cost center, multiple leases or properties will be grouped together. If all the properties are proved properties in a field or reservoir, then the aggregate cost of the leasehold will be amortized over the total proved reserves of the field or reservoir. Leasehold cost will not be amortized for the properties that are unproved in the field or reservoir. The total capitalized cost for wells and related equipment and facilities will also be aggregated and amortized over the total proved developed reserves of the field or reservoir. So let us solve an illustration in this regard. Lucky Company has interest in 3 leases, all obtained in January 2006, which covers the same field. 2 of the leases have been explored and proved. The well on the third lease, that is lease C, is incomplete and the lease remains unproved. So obviously it is not going to be counted. So Lucky decides to use the field as the amortization base for the DD&A. Information for each lease as of December 31, 2006 is given to us. We have all the information. We have the field-wide production also in barrels. We have the proved reserves total as well for the proved reserves. And we have the proved developed reserves at the end of the year for lease A and lease B. We have the total as well. And we have to compute the DD&A. So we are not going to count lease C because this is still unproved. We will take lease A and lease B. So the leasehold cost to be amortized will be 50,000 plus 40,000. So 50 plus 40 is 90,000 divided by proved developed reserve. Now this is given at the end of the year. So this will be 1,600,000 plus the production during the year, and that is 14,000 times production, that is 14,000. So that will give us 781, and this is the DD&A for the leasehold cost. Leasehold. Next, we are going to calculate DD&A for the intangible drilling cost and equipment. And for this, we have the intangible drilling cost of total cost will be 102 plus 40, 142 plus 81 plus 22. So that will be equal to 245,000 divided by the proved developed reserve. This is given again at the end of the period, 150,000. And to this we are going to add the production. The production was 14,000 times production, and this is equal to 20,915. So let us solve one more exercise on DD&A on a field-wide basis. Now, Lucky Company has interest in 3 leases, all obtained in January 2006, which cover the same field. Now, 2 of the leases have been explored and proved. The well on the third lease, lease C, is incomplete and the lease remains unproved. Lucky decide to use the field as the amortization base for DD&A, and the information is given to us over here, and we have to calculate DD&A for 2019, and then we have to calculate that we have 2 parts over here. So first of all, we will calculate DD&A for the year 2019. So once again, we take into account the production, and the production is 100,000, and we have 500,000 metric cubic feet. So this remains the same as 100,000. We convert it into barrels of oil equivalent. We divide by 6. That will be 83,333. So the total will be 183,333. Okay. Then we have the proved reserves, and for the proved reserves we have oil 1,020,000, and we have gas for 5 million. So once again, this will be the same 1,020,000, and we divide this by 6, 5 million. So this will be now 833,333. That is 1,853,333. Then we have the proved developed reserves, and the proved developed reserves are 900,000 barrels. So that remains the same, 900,000. And then we have in metric cubic feet 4,700,000. So that is 783,333, and this becomes 1683333. Now we are going to have the leasehold DD&A. Now you can see that the cost of the proved properties is 400,000. So we have the cost of proved property as 400,000, and we have the, you can see, unproved property proved during the year is 50. We have, this is the new proved property, so the total is 450,000 for the leasehold. So the cost to be amortized will be 450,000 divided by the proved reserves. That is now this is at the end of the year, 1,801,853,333 times the production, and the production is 183,333. So if we solve it, this will be 40,507. So this is the DD&A for the leasehold. And next, let us look for the wells DD&A, and for that we have the cost to be, first we determine the cost to be amortized. We have the intangible drilling cost of we have the intangible drilling cost of 3 million. We have the lease and well equipment 1,400,000, and then we have to subtract the accumulated. Okay, so we have the intangible drilling cost of 3 million, Then we have lease and value 1,400,000, and this is will be subtracted. This is accumulated depreciation 1,300,000, and then we have the new successful we are going to take only the proved, so we have the proved is 400,000. Then new development well of 300,000. Now you can see that we are taking, because this is for development. Then we have new service well for 325, and we have new tank separator installed 125. So the total cost is 4,250,000. So once again we can calculate the DD&A for the intangible drilling cost, lease and well equipment. So that will be the total production 183,333 times the cost to be amortized, that is 4,250,000, divided by the, don't forget, now we use proved developed reserves, that is 1,683,333, and to this we are going to add the production, and the production is 183,333, and if you solve it, this will be equal to 417,410. Okay. Next we go to part B, and we are going to solve this on the next slide. Now calculate DD&A for the year 2019, assuming that part of the field a proved property with gross acquisition cost of 30,000, gross equipment cost of 70, and gross intangible drilling cost of 215 was abandoned. Okay, so we have the, first of all we take the proved properties, that is gross, and the gross proved property is 500,000 plus 50,000, that, so that makes 550,000, and from this we have abandoned the properties for 30,000, so this has to be subtracted, so that gives us 520,000. Now accumulated depreciation is given to us as 100,000. From this we will subtract the property being abandoned, that is 30,000, that makes 70,000, and the total will be now obviously this is going to be subtracted, so the remaining remaining accumulated depreciation is 70,000, and we have the net cost of 450,000. Now what you can see that we have the net cost of 450,000, and we had the net cost of 450,000 here as well, because abandonment do not affect amount of net proved property cost being amortized, and the same would be true for wells and equipment. Therefore the amount amortized for B is the same as for A, that is 450,000. So the general entry is going to be accumulated DD&A. Now we have abandoned property worth 30,000, so our proved property is going to be credited by 30,000, and accumulated depreciation will be debit by 30,000. At the same time you can see that gross equipment of 70,000 and gross intangible cost of 215. So intangible cost of 215 was abandoned, and lease and well equipment for 70,000 was abandoned, that makes 285 to be debited for accumulated DD&A for lease and well equipment. Next, let us talk about estimated future dismantlement, site restoration, abandonment cost, and salvage values. Now, estimated future dismantlement, site restoration, abandonment cost, and estimated salvage value costs can be quite significant. That's why discussing their accounting treatment is important. Such costs must be taken into account in determining DD&A rates. There are two methods of accounting for estimated future dismantlement: site restoration and abandonment cost. In the first method, the costs are estimated and recorded as part of the wells and related equipment and facilities, and as a liability at the time the wells are drilled and equipment installed. In the second method, these costs are accrued as a liability as production and amortization takes place. In this method, the costs are not added to the cost of the underlying asset. So let us solve an exercise by both the methods. Future dismantlement restoration. During 2006, Lucky Oil Company completed development of an offshore lease. Total capitalized drilling and development cost were 70 million, and it was estimated that future dismantlement cost would be 15 million and future salvage value would be 2 million. Ignore leasehold cost. Proved developed reserves of 3 million barrels at the beginning of the year and production of 30,000 barrels. Now you see here they are giving us the proved developed reserves at the beginning of the year and not at the end. The estimated future costs are added to the cost of the asset, and so we have to follow the two methods. Now, first of all, we are going to look for the first method, and if you can recall, in the first method, the estimated future costs are added to the cost of the asset, and a liability is recorded when the equipment or facilities are put in place. So first of all, the journal entry will be wells and related equipment and facilities will be debit, and this will be debit by 70,000 plus future cost of 15, that makes 85 million. We have already paid cash for 70 million. For 70 million, and there will be a liability now for 15 million. Now, assuming proved developed reserves of 300,000 barrels at the beginning of the year and the production of 30,000 barrels, so the amortization will be 85 million, that is the cost, and we have a salvage value of 2 million divided by the proved developed reserves, and it is given at the beginning of the year as 3 million barrels times production of 30,000 barrels, so this will be equal to 830,000, and the journal entry will be DD&A expense debit by 830,000 and accumulated DD&A credit by 830,000. Next, we go for the second method, that is costs are accrued as a liability as production and amortization takes place. So in this second method, So we assume that only actual drilling and development cost is going to be recorded, and let us see how we do that. But we should also keep in mind that even though we are not going to record the liability, the future dismantlement, restoration, and abandonment cost, but it must still be included in the calculation of DD&A, and let us see how we do that. First of all, we are not going to include this liability, so let us see how we generalize. So once again, wells and related equipment and facilities will be debit, and this will be debit now by the cost incurred, that is 70 million, and cash will be credit by 70 million. Then we are going to make the DD and A calculations. So we have 70 million minus the salvage value of 2 million divided by the proved developed reserves, and that is 3 million, and the production is 30,000. So that gives us 680,000. Then for the liability part, we are also going to include this in calculating our DD&A. So the future cost was 15 million, and the proved developed reserves is 3 million, and the production was 30,000 barrels. So this is equal to 150,000. So if you make the total, this is 830,000. And the general entry now will be DD and A depreciation expense, DD and A expense, sorry, will be debit by 800. This will be debit by 830,000, and accumulated DD and A will be credited by 680,000, and we will record this now as a liability of 150,000. You can note that total DD and A amounts are the same regardless of which method we adopt, 830 and 830. Let us solve one more exercise on future dismantlement, restoration, and abandonment cost. Now, during 2018, Libby Oil and Gas Company completed the last well from its drilling and production platform off the coast of Texas. Unrecovered cost, not including decommissioning cost on December 31, were 25 million. So let us look into the cost to be amortized. So we have the acquisition cost, and the acquisition cost is 5 million in acquisition cost. To this we are going to add 20 million in drilling and development cost, and including 20 million, and what else? So 20 plus 5, 25. Okay, so total proved developed reserves were estimated to be 6 million barrels. Production during the year was 30,000. At the end of the life of the reservoir, decommissioning cost is going to be 14 million. So decommissioning cost will be added, and salvage value of 1 million is going to be subtracted. So this is going to be equal to 25 and 13 is 38 million. So the cost to be amortized is 38 million uh, times production during the year is given as 30,000 production, 30,000 barrels divided by uh, um, total proved developed reserve are estimated to be 600,000 as of January 1. So production will not be added in this case. It is just 600,000. It is at the beginning of the year, and when we calculate, this is 1,900,000. So this completes the first video on proved property cost disposition under successful efforts method, where we talked about cost disposition through amortization. We explained how to calculate DD&A. We explained how to calculate DD&A when oil and gas reserves are produced jointly and on a field-wide basis. And finally, we explained how to calculate estimated future dismantlement, site restoration, abandonment cost, and salvage values. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.